Welcome back to the Deep Dive. Our mission today, well, it's to take a pretty chaotic financial event, this really massive one-day stock drop, and turn it into some clear market intelligence, specifically for you.
Yeah, today the market really gave us a textbook example of, fear driving valuation. The Progressive Corporation, ticker PGR,
Right.
their shares tumbled roughly 9% just today in a single session.
Wow, 9%.
And the trading volume, it generated over $817.7 million.
Good grief, that's what,
Yeah.
$750 million of value just, poof, wiped out instantly.
Exactly. Gone. And that sharp, immediate movement, it just sparks this vital debate for anyone looking at this industry.
Is this panic actually justified? Is there some
Right.
underlying operational weakness we need to worry about?
Mm.
Or is this just the market doing what it does? Overreacting to noise and maybe creating a significant discount?
That's the core question, isn't it? Our
Yeah.
deep dive today is designed specifically to hold that short-term financial fear, that panic,
Yeah.
against the vast structural long-term competitive advantages that really define Progressive.
So we need to figure out if this sudden pain signals, deep-rooted problems, or if it's just turbulence, the kind you sort of accept when you own a technologically superior business.
Precisely. Is it real pain or is it opportunity? And to kind of set the stage for that uncertainty, let's maybe start with something that often speaks louder than any analyst report.
Insider activity, always telling.
It often is. And the sources we looked at point to a distinct, lack of confidence, maybe, from those who know the company best.
It's an unnerving data point, definitely.
It is. I mean, look at the past 6 months. Progressive insiders executed 24 separate open market sales of PGR stock.
24 sales. Okay.
And here's the critical part, the kicker, really. There were precisely 0 open market purchases by insiders during that same period. 0.
0 buys, 24 sells. That's stark.
It is. And when you look at the major players involved, the trend is just completely one-sided selling.
And we're talking top brass here.
Yeah.
Right? Not just mid-level managers.
Oh, yeah, the highest levels. The president and CEO, Susan Patricia Griffith, she sold shares estimated at nearly $15 million.
15 million. Wow.
And the chief financial officer also offloaded stock. His sales were worth over $12 million.
Okay, so CEO and CFO, both significant sellers.
Right. When executives, the people who have the absolute deepest insight into, quarterly operational hiccups, potential issues.
Yeah, the real inside view.
When they are net sellers to that degree, it just sends a palpable negative signal out to the street, regardless of the legality or the stated reason for the sale.
Like portfolio diversification or options expiring.
Exactly. Whatever the reason, the optics aren't great. It's frankly hard to reconcile millions and millions in insider selling with the analyst community at the same time saying the stock is a strong buy.
That tension is really interesting. And it feels like the perfect foundation for our deep dive today. Let's get into it. Okay, let's really unpack the immediate triggers. What set off this almost $800 million sell-off? We have to go straight to the Q3 financial report, right? Because that report seems to be the fuse.
Absolutely. The immediate catalyst, the thing everyone jumped on, was the pronounced earnings miss.
Okay.
Progressive reported an adjusted earnings per share, or EPS, of approximately $4.45.
$4.45. And what was Wall Street expecting?
Wall Street consensus was significantly higher. They were looking for something around $5.05.
Oh, so that gap, that's a negative surprise of roughly 20%.
Exactly, about 20%. And, for a company as large and usually predictable as Progressive, that's a jarring miss. That gets attention.
In the insurance world, a miss that big, it always traces back to profitability somehow, doesn't it? And the main indicator there is the combined ratio, the CR.
That's right.
We should probably take a moment to define that really thoroughly. It feels like the core metric driving this whole panic.
You're spot on. The combined ratio is absolutely the key measure of core underwriting profitability for an insurer.
Right.
Think of it as kind of the ultimate operating expense ratio. It combines 2 main things. The loss ratio.
Which is claims paid out.
Exactly. Claims paid out as a percentage of premiums earned. And the expense ratio.
Which covers everything else. Marketing, salaries, operations.
All of that. So if the combined ratio, the CR, is, say, 96%, it means Progressive spent 96 cents on claims and all those other expenses for every single dollar of premium it collected.
Leaving a 4-cent underwriting profit.
Precisely. And Progressive's long-standing operational goal, what they always aim for, is to achieve a CR of 96% or better. They want to maximize growth within that profit margin.
And historically, they've done pretty well with that.
They've actually done even better historically. Their average often hovers around 92%, so very profitable underwriting usually.
Okay, so with that baseline, How did the numbers actually break down this quarter? Because the headlines were all about a serious deterioration.
They were. And here's where it gets interesting. For the full third quarter, the overall CR rose to 89.5%.
89.5%. Now wait, if their target is 96% or better and their average is 92%, isn't 89.5% still really good? That's over 10 points of profit margin.
You're absolutely right. If you just look at that 89.5% number in isolation, it's actually still considered a very healthy CR. It represents a robust underwriting profit for the full quarter.
So why the panic? Why the 9% drop?
The fear was generated by the granular detail within the quarter. Specifically, the CR for the single month of September alone.
Okay.
It soared to 100.4%.
100.4%. Okay, there it is. That's the flash of red the market fixated on.
Bingo.
Because that means just for the month of September, Progressive actually paid out more in claims and expenses than it collected in premiums.
Exactly. They essentially lost money, just slightly, on their core underwriting activities for that one specific month.
So the market saw that muzzly spike above 100%, ignored the pretty good quarterly average, and basically hit the panic button.
That's precisely what happened. While the 89.5% quarterly average kind of smoothed things out,
Yep.
that 100.4% September figure screamed trouble to the algorithms and traders. It signaled that maybe loss cost inflation, rising repair costs, and maybe some pricing issues were catching up faster than expected. It hinted at a momentary loss of control over margins.
And this feels important. We have to look even deeper into that overall Q3 earnings miss, right? Because the most fascinating and frankly kind of counterintuitive driver of that big miss wasn't just the 100.4% September CR. It was something else entirely.
Yes. This is where the story gets really complex, and it's probably the most crucial piece of information for you, the analyst, trying to understand this.
Okay.
Progressives took a staggering $950 million charge against its Q3 earnings, and it was related specifically to its Florida auto unit.
$950 million, right? A charge approaching $1 billion. I mean, your first thought goes to catastrophes, right? A massive hurricane hit, some huge flood loss, maybe a terrible acquisition write-down.
That's the natural assumption. But the actual cause was the exact opposite of a catastrophe.
The opposite? How?
It was due to excessive success.
Wait, what?
Yeah.
You get charged for being too successful.
In this specific regulatory environment, yes. This massive charge was mandated by Florida state law, not because Progressive had poor underwriting results in Florida, but because the Florida unit's profits were actually too high.
Seriously?
Seriously. Florida state law enforces a statutory limit on how profitable auto insurers can be over a specific 3-calendar-year period. Progressive's ability to segment risk, price policies accurately, and basically underwrite profitably in Florida was so superior.
They were just too good at it.
They were literally too good. They exceeded that legal profitability threshold, which forced them to book this $950 million charge against earnings, effectively acting as a refund mechanism.
So let me get this straight. The $950 million hit, which was the primary driver of that big 20% EPS miss that spooked market, was actually a regulatory consequence of long-term underwriting excellence in that state.
That is absolutely correct. It completely reframes the narrative, doesn't it?
It totally does.
Yeah.
The market interpreted this massive charge as some kind of operational disaster, maybe a sign of things falling apart.
Right. Red flag.
Yet the underlying reality is that it was a mandated return of capital because the business was fundamentally too efficient and too profitable over a sustained period.
It highlights the friction, right? This regulatory friction is almost an unavoidable, maybe even expected operational cost when you run a highly successful, structurally superior insurance business within a heavily regulated environment like U.S. auto insurance.
It's the ultimate bug or feature question for investors, isn't it? Is this a problem or a sign of dominance?
That's a perfect way to put it. And it sets up this perfect conflict because while profitability took that weird regulatory-driven hit,
Growth didn't.
not at all. We absolutely must juxtapose that profit dip against the incredibly robust volume increases. It shows customers are still flocking to Progressive regardless of these quarterly earnings hiccups.
Okay, let's see those top-line numbers. How strong was the growth?
The figures are phenomenal, really. They reflect a company that's still aggressively taking significant market share. Net premiums written, that's the new sales coming in the door, increased a very robust 10% year over year in September.
10% growth in new business?
Okay. And maybe even more importantly, total policies in force, or PIF, That's the
Yeah.
total number of active
The
customers.
lifeblood metric, yeah.
Exactly. That grew 12% year over year across all segments. They hit over 38 million active policies.
38 million policies growing at 12%.
Yeah,
That's huge scale and solid growth.
it's massive. But,
Yeah.
and here's the contrast that scared the market. While that top line was surging, the short-term profitability erosion, driven by that September CR spike and amplified by the Florida charge, it was severe.
How severe?
Well, the combination meant that September net income available to common shareholders just plummeted. It dropped 48% compared to the previous September.
Wow, almost half.
Yeah, fell from 99 per share down to 52 cents per share for the month.
And the market just fixated on that 48% drop, right? Probably ignored the nuance of the regulatory refund and the strong policy growth.
That seems to be exactly what happened. They saw the headline, net income down 48%, and didn't necessarily connect it back to the non-operational mandatory Florida refund or balance it against the 12% policy growth.
Okay, but still, a charge of nearly $1 billion, even if it's for good reasons, it begs an immediate question about financial stability. How solid is the foundation underneath that charge? Let's quickly check the balance sheet.
Good call. And the balance sheet remains a real picture of resilience and strength, which is absolutely vital for an insurance company that needs to pay claims potentially decades down the road.
So they're not drowning in debt or anything?
No, not at all. Progressive is definitely not debt-laden. They have manageable total debt, roughly $6.9 billion on the books.
$6.9 billion, okay.
But what's more telling is their ability to easily cover the interest on that debt. If you look at the September comprehensive income statement, their income before income taxes was a healthy $392 million for that single month.
Right.
Compare that to their interest expense for the same month, which was only about $8 million.
Wait, $392 million in pre-tax income versus $8 million in interest expense. That implies
What?
an interest coverage ratio of nearly 50 times.
Approximately 48 times, yeah. It's fantastic.
48 times. That means they're generating $48 of income for every dollar they need just to pay their interest obligations. They are like financially bulletproof from a debt perspective.
Pretty much. And this financial strength feeds directly into management's stated capital strategy. They explicitly say their number one focus is protecting the balance sheet.
Makes sense for an insurer.
Right. And they manage their investment portfolio very deliberately with a short duration.
Why is short duration important?
Well, it's a key strategic decision, especially in a rising interest rate environment like we've seen. A short duration means their investments mature relatively quickly.
Ah, so they can take that cash as it matures?
And redeploy it quickly into newer, higher yield instruments that become available as rates go up.
Got it. So they're not locked into low-yielding bonds for years and years. They can adapt.
Exactly. It ensures their cash reserves, their float, is working as hard as possible to generate investment income, which supports the operational growth. Bottom line, they are structurally sound and very well positioned to handle market volatility or unexpected charges like the Florida one.
Okay, so we've kind of established that the immediate pain seems to be mostly short-term, maybe largely non-recurring noise, like that Florida chart.
Right.
And it's all underpinned by a very strong balance sheet. So now, let's zoom out. Let's look at the long game. What truly defines Progressive's superiority? What's the competitive edge that lets them ride out a single quarterly miss like this?
Yeah, the answer almost unequivocally is Progressive's a primary competitive moat. Their technological leadership, specifically in usage-based insurance, or UBI.
UVI.
Progressive wasn't just an early adopter of UBI. They were essentially the first mover at scale. They branded their system as Snapshot, and most people have probably heard of it.
Snapshot, right. You plug a thing in your car or use an app.
Exactly. And being the first mover here is a crucial distinction.
And we're not talking about a technology they just rolled out last year or something, are we? This goes back a ways.
Oh, a long ways. We are talking about literally decades of entrenched data collection and refinement.
Decades, really.
It's an incredibly long runway. Progressive has been experimenting with and offering UBI concepts for over 25 years.
25 years, wow.
Yeah. They started way back with something called Autograph in 1996. Then they evolved through other systems like TripSense in 2004, MyRate in 2008,
Right.
before finally launching the Snapshot brand we know today in 2010.
So that decade-plus lead, just with the Snapshot brand itself, in mass market data collection, that's got to be a huge hurdle for competitors trying to catch up now.
It's almost insurmountable. Think about the sheer volume of driving data they've accumulated over that time. Miles driven, braking habits, time of day driven, acceleration.
All from millions of drivers over 10+ years.
Exactly. So how does having all that specific granular driving data translate into a concrete competitive moat? What's this data advantage cycle that helps them consistently outperform?
Yeah, break that down.
Okay, it creates this really powerful, self-reinforcing advantage loop. First, the data itself. That granular driving data allows Progressive to segment risk far more accurately than its peers.
Peers who are still relying more on older, generalized metrics.
Right. Competitors often still lean heavily on things like age, gender, zip code, credit score,
Yeah.
proxies for risk, essentially. Progressive has actual driving behavior data.
Makes sense. What's the second part of the loop?
Second, superior segmentation means superior pricing. Progressive can identify the genuinely least risky drivers with much higher confidence.
And offer them bigger discounts based on their actual safe driving.
Precisely. Which helps them retain those best drivers, systematically improving the overall quality and risk profile of their entire insurance pool over time.
Okay, so they keep the good risks. What about the bad risks?
That's the third part. By accurately identifying and pricing the highest risk drivers, or sometimes choosing not to insure them at all if the price would be astronomical, they continuously manage down their potential for large claims. This directly lowers their loss ratio.
Which is the biggest component of that combined ratio we talked about.
Exactly. This superior data-driven understanding of risk is the fundamental reason why Progressive typically maintains a lower, more profitable combined ratio, even when the broader insurance market is struggling with inflation or other pressures.
You mentioned they keep innovating. This technological edge isn't just sitting there, it's evolving.
Absolutely not stagnant. We see constant innovation in the Snapshot program. It's moved way beyond just being a simple discount program.
How so?
Well, initially, back in 2010, Snapshot was purely a discount vehicle. Drive safer, get a discount.
Yeah.
Simple. But by 2014, they took a crucial step. They introduced the possibility of a small surcharge for demonstrably riskier drivers identified through the data.
So it became a two-way street, not just rewards, but potential penalties too, moving towards true risk-based pricing.
Exactly. And now, with the current rollout of what they call Snapshot 5.0, they have continuous monitoring. It's not just a one-time plug-in period anymore. The app or device continuously monitors driving, and the rate can potentially adjust at each policy renewal based on recent behavior.
Wow, continuous monitoring. That provides almost instantaneous data feedback and allows for much faster pricing adjustments. The policy becomes incredibly dynamic and predictive.
That's the idea, making the price reflect the current risk much more accurately and quickly.
But are customers actually adopting this? Are people comfortable with that level of continuous monitoring, giving up that much data, that much privacy?
It seems they are, increasingly. The financial incentive is clear, right? The potential for a lower premium is a strong motivator. And the numbers back it up. Snapshot enrollment rates, according to the sources, have climbed approximately 40% just since January 2019.
40% growth in enrollment in just a few years.
Yeah.
That's significant adoption.
It really is. It shows the market is getting increasingly conditioned to this idea of exchanging driving data for potentially lower insurance costs. People are making that trade-off.
And it's not just personal auto insurance, is it?
Yeah.
You mentioned they're leveraging this elsewhere.
That's another key point. They are successfully porting this core competency, this data-driven approach, into other lucrative markets.
Like commercial lines.
Exactly. Progressive is leveraging its vast personal auto telematics experience to aggressively grow its commercial telematics programs. Things like Smart Haul for truckers or ProView for other commercial fleets.
Remarkable.
And they've publicly stated that telematics data is, and I quote, their most predictive rating variable for commercial auto risk as well.
That's huge. So they're taking what they learned over 25 years in personal auto and applying that same data moat, the same principles of superior risk segmentation, to a highly profitable secondary market, like commercial trucking and small business fleets.
It's a classic example of leveraging a core competitive advantage into adjacent markets. It significantly expands their addressable market and reinforces their data leadership.
This kind of technological dominance, it brings us naturally to the competitive landscape.
Yeah.
We know Progressive is the second largest private passenger auto insurer in the U.S., but the constant shadow, the big rival in this direct-to-consumer space is always GEICO, right? Owned by Warren Buffett's Berkshire Hathaway.
Absolutely. The Progressive versus Geico rivalry is really the key technological and operational battleground in U.S. auto insurance. They are almost universally seen as the two dominant long-term winners.
Why those two specifically?
Because they both successfully mastered the direct-to-consumer model decades ago. They bypassed the traditional, often costly, agent networks.
Right, cutting out layers of agents and overhead.
Exactly, which allows both of them to operate much more efficiently, with structurally better combined ratios than most of their traditional competitors who still rely heavily on agents.
And the sources we looked at actually reference Warren Buffett himself acknowledging this intense competition. His words kind of underscore the high stakes of this tech war.
Yeah, Buffett has always been pretty brutally honest about this rivalry. He doesn't sugarcoat it. He essentially admits that while Geico is obviously formidable, a powerhouse.
Of course.
Progressive often pioneers the technological front, particularly with UBI and data analytics.
Is there a specific quote?
There's that famous line where he's talking about competition, acknowledging a rival's strength, and he says something like, somebody's a little better at something that we are. You've noticed I'd settle for second place in a lot of the business.
Huh. Settle for second place. Coming from Buffett, that's quite an admission.
It really is. It implicitly acknowledges that Progressive's UBI leadership, their snapshot program and the data behind it, represents a massive, formidable hurdle for Geico to overcome, even with all of Berkshire's resources.
So it sounds like while Geico might often rank higher in things like overall customer satisfaction surveys,
Which they often do.
Progressive consistently seems to maintain the actual lead in the underlying technology of pricing risk accurately through data.
That's generally the perception in the industry, yes. Progressive is seen as the tech leader. Geico may be more the marketing and customer service leader, but both are incredibly strong overall.
That Buffett quote really encapsulates why this isn't just business competition. It feels like a true technological arms race for market share.
It absolutely is.
But,
Yeah.
and this is critical, given how utterly dependent Progressive is on this data-driven model on snapshot and telematics, what is the single biggest structural risk to this entire moat? What could actually threaten it long term?
Yeah, that's the key vulnerability. The core long-term risk probably isn't another insurance company suddenly leapfrogging them technologically or some massive operational failure internally.
So what is it?
It's external. It's regulatory threat. If you look at Progressive's own risk factor disclosures in their SEC filings, they clearly identify compliance with complex and changing laws and regulations as a primary ongoing concern.
And that $950 million Florida charge we spent so much time on earlier,
Yeah.
that's a perfect concrete manifestation of exactly that regulatory power, isn't it?
It's the poster child for it. That Florida situation perfectly illustrates the immense power individual states hold over insurance pricing, profitability, and even product structure design.
So the fear isn't just one-off charges like that, but something broader.
Exactly.
Right.
The most severe long-term regulatory threat is the possibility that states may be motivated by consumer advocacy groups or increasing privacy concerns, or just a desire to make insurance seem fairer in a non-actuarial sense. Might impose much stricter rules that either restrict the use of usage-based insurance data altogether or significantly limit how insurers like Progressive can segment risk based on that data.
So if regulation said you can collect driving data, but you can't use braking habits or time of day driving to set the price anymore.
Exactly. Or everyone in the zip code has to fall within a narrower price band, regardless of their snapshot data. If Progressive's ability to leverage its superior 25 years of telematics data to price policies accurately and individually is significantly curtailed by regulation,
Then that entire technological moat starts to erode very quickly.
it does. Their loss ratio advantage, their core competitive edge, would diminish substantially. That is absolutely the vulnerability that must keep Progressive's management team up at night.
Okay, so we've really laid out the conflict here.
Yeah.
You've got this short-term friction, the regulatory noise like Florida, the quarterly earnings miss.
Versus this incredibly powerful, enduring technological moat built on decades of data. So let's try to synthesize all of this into an investment calculus for someone looking at PGR today after that drop. Starting with the Grace drivers. Where exactly is Progressive accelerating right now? What are the tailwinds helping them?
Well, the growth, interestingly, is concentrated precisely in the channels where their technological edge is strongest, that direct-to-consumer model we talked about.
The online channel, Progressive.com, the app.
Exactly. Direct auto policies enforce the number of customers buying directly from them, saw absolutely astonishing growth. It
Yeah.
was up a staggering 17% year over year in the latest reporting period.
17% growth in their core direct channel. That is huge.
It's phenomenal. And even the agency auto channel, where they sell through independent agents, that PIF also grew very strongly at 13% year over year. So they're succeeding across the board, but accelerating fastest where their tech advantage is most pronounced. 17% growth in the most critical, most technologically advanced channel. That is definitely not something you just ignore, especially when you combine it with their operational superiority, which shows up in the financial metrics, right?
Absolutely. This is where we can really confirm that structural superiority we've been discussing. Progressive consistently delivers best-in-class financial metrics, which demonstrates just how effective their model is at allocating capital and generating returns.
Which metrics specifically?
The two big ones are return on equity, ROE, and return on invested capital, ROE.
Okay.
Their ROE currently stands at a very impressive 38.29%,
38% ROE.
and their ROIC is 31.27%.
31% ROIC.
Okay, for our listeners who might not live and breathe these financial ratios every day, can you just quickly contextualize those numbers? What do ROE and ROIC actually tell us about Progressive compared to others?
Sure. So ROE, return on equity, measures how effectively a company uses the money invested by its shareholders to generate profit.
Okay, profit on shareholder money. Right. And ROIC, return on invested capital, is a bit broader. It measures the return generated from all the capital invested in the business, including debt.
Got it.
Now, numbers in the high 30s for ROE and low 30s for ROIC. Those are simply phenomenal for the property and casualty, P&C, insurance sector.
Much higher than average.
Oh, significantly outpacing industry averages. They indicate that Progressive is not only generating exceptional profit, but crucially, they are doing so by being vastly superior at utilizing the capital they have compared to their peers. They are truly best-in-class operators.
And you'd argue that efficiency is a direct reflection of the competitive advantages gained through their data moat and technology.
Without a doubt, the ability to price risk better means less wasted capital on unprofitable policies, which flows directly through to higher returns like ROE and ROIC.
That growth and that efficiency are really impressive.
Okay.
They are fighting a pretty powerful headwind right now, aren't they? That near-term industry risk, specifically loss cost inflation, that's what drove that scary September 100.4% combined ratio.
That is absolutely the immediate challenge, the biggest near-term risk factor. CEO Tricia Griffith has confirmed it in recent communications. She said their pricing strategy is constantly trying to reflect both claims frequency and severity.
Right.
And while she noted severity might be slowing down just a little tiny bit, pricing adjustments are still earning their way in. Inflation concerns persist fiercely, particularly around the key inputs for claims costs. Things like used car prices, body shop prices, repair parts, and garage labor costs.
And what happens when the cost of fixing cars, the parts and the labor, just keeps going up and up?
It creates that classic painful catch-up challenge for insurers. Rising repair costs, what the industry calls loss cost inflation, systematically erode Progressive's profit margins unless they can immediately hike their premium rates to offset those higher costs.
But they can't always just hike rates instantly, can they? Don't they need approval?
Exactly. Rate increases often face significant delays because they have to be filed with and approved by state insurance regulators. Sometimes regulators push back or limit the size of the increase.
So there's a lag. Costs go up now, but the price increase to cover it might not come for months.
Precisely. And that gap, the delay between loss costs rising and Progressive being allowed to raise premiums sufficiently to cover them, that's exactly what caused that painful 100.4% combined ratio spike back in September. They were essentially temporarily underpriced for the current inflationary economic reality.
Makes sense. We should probably also briefly mention the constant underlying pressure from just big bad events, catastrophes.
Absolutely. That's always a factor in insurance pricing and profitability. Their enterprise risk management ERM program has to constantly model and price in the increasing risks associated with climate change, more severe storms, wildfires, etc.
Like the recent hurricanes, Helene and Milton, for example.
Exactly. Dealing with those requires maintaining robust and often very costly reinsurance programs to protect their balance sheet from massive, unpredictable losses. Plus, they need careful pricing strategies in catastrophe-prone areas. It just adds another layer of constant pressure on those overall margins.
Okay, so let's bring it all together. Let's get to the ultimate decision point for an investor looking at this today. We have this backdrop, a 9% stock drop, seemingly driven by concerning insider selling, a huge but weirdly good news regulatory refund charge, and these very real inflationary pressures.
Right, the negatives.
Versus phenomenal 17% policy growth in the key direct channel, best-in-class returns like ROE and ROIC, and this 25-year technological head start with Snapshot. Given this conflict, what's the final verdict looking like based on the data? Is it a buy, a hold, or a sell for PGR right now?
Well, looking at the analyst consensus and the arguments being made, I think the predominant bull thesis is actually highly compelling. It directly addresses that tension you just laid out.
Okay, what's the core bull argument?
The consensus argues, pretty forcefully, that the Q3 earnings miss was overwhelmingly dominated by that technical, non-recurring $950 million Florida charge. It wasn't really an operational miss in the traditional sense.
They were too profitable.
Exactly. So the bulls argue that the underlying operational metrics, that staggering 17% direct policy growth, the strong agency growth, the historically excellent long-term combined ratio, average around 92%, they believe those fundamental strengths remain perfectly intact.
So the market fear, the sell-off, is presenting a classic value opportunity, buying a great company on temporary bad news.
That is the exact conclusion many analysts are drawing. They see this decline as a gift, essentially. We saw at least 2 firms reiterate or issue new buy ratings very recently, right after the drop. And the median price target across, I believe it was 11 analysts covering the stock, is currently sitting at $273 per share.
$273. That suggests, well, pretty significant upside potential from where the stock landed after that 9% hit, doesn't it?
It certainly does. The core argument is that you are getting the chance to acquire a technologically superior, resilient compounder, a long-term winner at a temporary discount. And that discount exists mainly because the market misinterpreted the severity and, more importantly, the nature of that non-operational Florida charge.
Okay, that bull case sounds strong, focusing on the long-term strengths.
Yeah.
But I have to push back a little. I have to challenge that conclusion. If we trust the analyst consensus saying this is a screaming buy opportunity, why on earth did the insiders, the CEO and CFO, the people who see the inner workings every single day, sell over $27 million worth of stock combined in the last 6 months with 0 buys?
Yeah.
Isn't that the most tangible, hard evidence of potential operational concern or maybe valuation concern that we actually have? How did the bulls reconcile that?
That is a completely fair and essential question to ask. It's the elephant in the room, really.
Right.
The standard counterargument, the one you always hear to dismiss insider selling, is that executive compensation structures are heavily weighted in stock options these days, and that these sales are often pre-planned months in advance under Rule 10b5-1 plans purely for personal financial planning reasons, like portfolio diversification or maybe meeting tax obligations when options vest.
Okay, the planned sale defense.
Right. However, the sheer volume of selling we saw here, nearly $30 million from just 2 top execs, and crucially, that absolute 0 purchase rate across all insiders, that does complicate the simple diversification explanation somewhat. It feels like a lot of selling if everything is perfectly rosy.
It does feel like a lot.
Ultimately, the bull case has to rest on the conviction that the long-term structural advantages, the data moat, the technology lead, the efficient direct model, that these factors will eventually trump any short-term profit-smoothing issues caused by inflation or these occasional regulatory compliance speed bumps.
And this tension, this willingness to maybe ignore short-term bumps for long-term gain, it actually aligns perfectly with Progressive's own stated corporate philosophy, doesn't it? That provides the ultimate context for understanding today's volatility.
It truly does. It's almost like management told us to expect this kind of thing. Progressive's explicit, long-stated corporate goal is, and I'm quoting them roughly here, to maximize the long-term value of the enterprise.
Maximize long-term value.
Okay? And they have been incredibly clear over the years, very consistent, that in pursuit of that goal, they are willing to accept the impact from not managing to short-term earnings expectations.
So they're basically saying, don't judge us quarter by quarter if we're making decisions for 5 or 10 years down the road.
Exactly. They're focused on that core profitable growth target, maintaining that 96% combined ratio or better while growing as fast as possible within it. They are fundamentally playing the long game.
So today's 9% drop in the eyes of the bulls and maybe even management itself is simply what? The operational cost, the noise you endure when you prioritize building long-term market share and maintaining superior underwriting standards over just appeasing Wall Street's quarterly earnings expectations.
That's a perfect summary of the bull perspective.
Therefore, putting it all together, the final verdict seems to lean pretty strongly toward the long-term strength outweighing the short-term noise. The superior data moat, the clear technological advantage, the proven operational efficiency reflected in or EROIC appears to justify the bullish valuation, despite the messy Q3 miss and the very real near-term pressures of inflation.
Yeah, when you look at the core machine,
Mm-hmm.
it's still growing policies by 17% year over year in its most critical channel. It's backed by immense balance sheet strength and fortified by a generational data advantage built over 25 years. That kind of enduring excellence historically tends to reward investor patience. Hashtag outro.
So this deep dive really forces you, the listener, to weigh a fundamental conflict, doesn't it? Does the immediate market panic the fear triggered by a 100.4% September combined ratio, which itself was exacerbated by that huge $950 million non-recurring mandatory regulatory refund?
Right.
Does that short-term chaos outweigh Progressive's decade-plus technological lead in telematics? A lead that is currently delivering stunning 17% growth in its core direct auto channel.
It really is the classic short-term noise versus long-term signal dilemma playing out right before our eyes. And maybe here's a final provocative thought for you, the analyst watching this unfold. One that builds directly on that bizarre Florida charge situation.
Okay.
Progressive explicitly states, as we just discussed, that its management strategy is laser-focused on maximizing long-term value, often even at the expense of smooth, predictable short-term earnings.
Right. They accept that trade-off.
So if the company is actually so successful, so dominant in a market like Florida that it gets forced by state law to refund nearly $1 billion in profit simply because it exceeded limits on excessive profitability.
Yeah.
How should you, as an investor, interpret future large, non-recurring charges of this specific nature if they happen again in other states?
That's a great question.
Should those charges be viewed as genuine operational setbacks, signs of trouble? Or are there simply the occasional, perhaps even expected, unavoidable operational cost of running a structurally superior, high-margin, dominant insurance business within the complex, highly regulated environment of the United States?
Is being forced to give back profits because you're too good a bug? Or is it actually a feature confirming Progressive's long-term success?
That core question bug or feature is ultimately what determines whether today's painful 9% stock drop is truly a long-term discount opportunity or just the beginning of more regulatory headaches.
Definitely some food for thought there. Thank you for joining us on The Deep Dive.